Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering the important theory, numericals, objective questions and case studies. So watch the series till the end and also watch the complete series, all the videos, okay, at the same time every day. Let's start. First one, let's start with the objective questions. What risk arises from the lack of trading liquidity? Trading liquidity. What do you mean by this term trading liquidity? Trading liquidity means for trading, I don't have the funds. I might be having huge amount, but for trading, I don't have the funds. Means what? Imagine if I keep all the funds of mine in FD, complete all the funds in FD. That also, that FD is on maturity, nothing in between. So is it of any use? How will I do my daily expenses? Okay. Or second case, trading liquidity means I need to have daily funds. So similarly banks also. So imagine a bank investing all its funds. Understand this, whatever I am telling you. Imagine a bank investing all its funds, all in what? In let's say 10 years bonds. 10-year bonds. What do you mean by 10-year bonds? 10-year bonds mean the maturity you will be getting, the money you will be getting after 10 years. So in between, if you require the money, you won't be having anything. You'll say, how can this happen? But this has happened. In 2022, you saw one bank in USA collapse. That was called as SVB Bank. If you don't know about this, kindly Google it. SVB Bank, Silicon Valley Bank. The bank, why did it fail? Do you know? Because of this trading liquidity. It invested all its funds which it had from the savings and current account. It invested those funds in long-term bonds of 30 years. Because of that, it didn't have any money for day-to-day trading. Okay, and because of that, it faced a huge problem. And it collapsed. Such is the severity of trading liquidity. So which risk arises from the lack of trading liquidity? Funding liquidity risk, asset liquidity risk, liquidation risk, and market liquidity risk. So which risk arises from this? Yeah, think over it. Think. Yes. I'll wait for your answer almost, let's say, 10 seconds more. Just now I gave you the example. What happened to SVB Bank? It went into, what is it called as? When the bank collapses, when the bank fails, it is called the bank has gone into funding liquidity, asset liquidity, liquidation, or market liquidity. What is it called as? Type in the comment section, everyone. It is called as, yes. Let me see how many of you are typing and what are you typing, you guys. It is called as liquidation risk. Liquidation means bankruptcy. So this bank had faced the bankruptcy. Similarly, all the banks might face the bankruptcy if they don't follow the asset management this matching concept. Okay, that's why RBI has come up strictly to avoid this trading liquidity. RBI has tells the bank to follow what? Gap system or bucket system. Gap, or you call it bucket, right? That's why we have this the team called as ALCO in our bank. ALCO team does the same job, right? Got it, everyone? Clear? A particular corporate security has been facing the lack of trading liquidity. This is called as funding liquidity risk, asset liquidity risk, asset liquidation risk, and market liquidation risk. Now think over this. Now we are talking specifically of a typical corporate entity. Okay, so it is facing a lack of trading liquidity. So right now it is facing this trading liquidity? So the answer will be funding liquidity, asset liquidation, and market liquidation. Excuse me. It is called as think. Answer generally in the exams what you feel as a first answer. Everyone please pay attention. In exam, whatever you feel as a first answer is generally the answer. Whatever you feel, see as a first answer. Now, many amongst you over here felt that the answer is asset liquidation risk, because just now we saw that liquidation part in the first question. But some of you thought that how can the answer be so obvious? First liquidation, now again asset liquidation, there will be something different. So you thought of something asset liquidity, you try to tick on this A, B or D. But remember, generally in exam, whatever you feel as a first answer after reading the question, that is generally the correct answer. Okay, so the answer is asset liquidation risk. Again, we are focusing on liquidation only. I have taken 2 questions on liquidation right now. Why? Because both the questions were on liquidation, because this is the major risk faced by the banks. I gave you that example of SVB Bank, Silicon Valley Bank, right? Similarly, there was another bank failure in same year, 2022 only. There was one more bank which had failed. That was called as biggest. That is called as Credit Suisse. Credit Suisse, right? It was a Switzerland bank, and then it was purchased by UBS. It was purchased by UBS, right? Even UBS is facing the problem now. If you see UBS right now, if you check the UBS situation, they are also facing some problems. So forget it. That's not our concern. Our concern is Credit Suisse was purchased by UBS. Because of this, again, this liquidity issue. Okay. The general liquidity crunch in the market, and there is a general liquidity crunch in the market, and it is affecting the trading liquidity adversely. It is called as. See, here the questions are similar. You might feel that the answers are also similar, right? There is a general liquidity crunch in the market, and it is affecting the trading liquidity. Now, see here, liquidity crunch in the market means overall market there is a liquidity crunch. When did this thing happen? Liquidity crunch in the market during the COVID time. Remember, in COVID time there was a huge fall in the overall investment culture, and it led to this trading liquidity adversely. Of course, India didn't suffer that, because in India during the COVID time, if you see, the stock markets rose like anything. They were up. Only in the first wave, means first date of March 20, right? The COVID, the stock markets fell. Otherwise, they only went up. But that was only in India. It was not the case in other countries. So coming back to our question, there's a general liquidity crunch in the market, and it is affecting the trading liquidity adversely. Means because of this crunch in the market, I am not getting the funds for trading. So this is called as what? Funding liquidity risk, asset liquidity risk, asset liquidation risk, and market liquidation risk. So what is it called as? 8th one. Yeah. Now think over it. See here, it's a crunch in the market, overall market. Now when you see the word market over here, what should strike your mind? I know all of you are in a fix right now. Fix means in the Jeopardy we call it, or we call it this or that, this or that. Many of you are in the problem of A or D. Funding liquidity risk or market liquidation risk. What is the answer between these? Yes. See here, again, go to the obvious answer. What is the obvious answer? The obvious answer is what is given in the question, market word. So same market word will be used over here. Market liquidation risk. Okay. Market liquidation risk. So there is a general liquidity crunch in the market and it is affecting the trading liquidity adversely. So it is called as market liquidation risk. Okay, got it? Clear? Next one. The credit risk of traded debt securities such as bonds, debentures, and commercial papers is indicated by. So the credit risk of the traded debt securities, traded, what do you mean by traded? Those debt securities which are tradable in the market. Okay, what do you mean by tradable? See, there are two types of market. One is primary market and second is secondary market. What is primary market? When I purchase the bonds from that company, let's say simple word IPO. Whenever I purchase the shares or bonds from the company itself. So let's say Reliance, okay, Reliance is selling the shares or bonds, let's say, let's call it bonds today, okay. Reliance is selling the bonds and I purchase the bonds, I buy the bonds from Reliance. So this is known as primary market. I brought it directly from Reliance. Now if I sell these bonds to somebody else, like let's say you, I sell the bond to you, then this is called as secondary market. So whenever you purchase, you are not purchasing from Reliance, you are purchasing from me. Now where is the relation of this concept primary and secondary market to traded debt securities? It means there is a relation. The relation is traded means what? It should be tradable in the secondary market. Anything which is tradable means if you are ready to buy the bonds from me, only then it makes sense for me to buy in IPO. If the bonds are not being purchased by anyone other than me, then will I be able to sell them to others? Will I be able to earn the profit? That is called as traded debt securities, which are tradable in the market, such as bonds, debentures, commercial papers, is indicated by the earnings from these securities, the face value of these securities, the credit rating of these securities, and all of the above. Think over it. Yeah. How do you decide whether this bond from Reliance will be purchased? Means how do you means how will I decide? Suppose if I am going to purchase it, how will I decide whether somebody will buy this bonds? If means the Reliance bonds which I purchased, will somebody buy from me? How will I decide? So I'll decide this based on what? The earnings from the securities. Earning means what? Earnings. What do you mean by earnings? The returns which I get. But there are many bonds in the market which give you high return, but these are very scrap bonds. You see any Z company, Z group stock or T group stocks. Okay, they give you returns of around 1000%, right, in 1 month. But do you trade in them? No. Why? Because what is the credit worthiness of those companies? Same thing is over here. The earnings of the securities is not a criteria. The face value of the securities. Face value means what? What do you mean by this word face value? Face value, you had this term in the bonds, right? Face value means that the amount which you get, which is written on that paper, which you get on the maturity. So that is also not important. The important part over here is credit rating. Credit rating of the securities is of the utmost importance. Utmost. If the credit rating is good, only then others will buy the bonds. Suppose if I sell you the bond of Kingfisher Airlines, Kingfisher. You know this Kingfisher, Vijay Mallya's company, bankrupt. Suppose if I sell you the bond of Kingfisher Airlines, will you buy it from me? No. Although it might give you 1000 times returns, but you will not buy it. Okay, so that it's all the credit ratings. When the rating of a financial instrument is lowered by a rating agency, the spread over the risk-free rate, what does it happen? Increases, decreases, remains constant, there is no relationship. Means what do you mean by this? Suppose if the rating is lowered, means what? If I am having a bond which is AAA, now let's say the bond is reduced from AAA to let's say BBB, means lowered. triple A to triple B, what will happen? Rating reduced. So what will happen? All of us, suppose if you are going to buy this bond, you will think this triple A has gone to triple B means there's some problem in that company. So if that there's a problem in that company, what will happen to the spreads? Spreads means the difference. The difference, okay? Difference between the funds which are received and funds which are given, okay? So incoming and outgoing funds, that is a spread, right? Difference between them. So what happens to that? It increases as the market demands higher yield on higher risk instruments, decreases as the market expects lower yield on the higher risk instruments, remains constant, no change, nothing will happen to this, and there is no relationship. Very, very, very important question. You guys must follow this and must be able to think over it. So what is the answer now? Think. The answer is A, increases. Many of you have written this decreases, but it increases. Why increases? Because as the rating goes down, people will be demanding higher rate of interest. Means, let's say if the company was giving 4% rate of interest, 5% earlier, now it has gone down. So you only, if you think of yourself, you are investing in this bond or this FD or this share, anything which is giving you 5% returns. Now it has gone down to triple B, so rating is reduced. So what will it tell the company? No, I'll buy this only if you give me 7% returns. Because I'm taking higher risk now. Why? Because you guys have been downgraded from triple A to triple B. So you are just downgraded. You have gone down. So now to compensate for this downgrading, you pay me higher rate of interest. So it increases, spread increases, because the incoming funds will increase. Earlier they were coming at 5%, now they are coming at 7%. Okay, so that is the answer. The process of market risk management has the following parts. 1. Risk identification, risk measurement, risk monitoring and control, risk mitigation, and risk pricing. So the process of market risk management has the following parts. What parts does it have? Market risk management. What are the parts? 1 to 5 all. Risk identification, measurement. See, here risk management we are talking of. Management. Identify, measure, monitor and control, mitigate and pricing. Ideally, what do you think should it have? What do you think? All of them? 1 to 5 all? I am saying the answer 1 to 5 all. Again, you have fallen in the trap. Why trap? Because you haven't studied this concept very clearly. See this important part, risk management. Management means identify the risk, measure the risk, monitor the risk and mitigate the risk. Pricing is not the part of risk management. Pricing is different. So the answer is 1 to 4 all, not 1 to 5. Risk pricing is separate. Risk pricing is done not by you. It is done by the buyer. What a logic. See here, risk pricing will be done by the buyer, not by that company. Suppose let's say you are buying an instrument, a share, which is, let's say, again come back to some bankrupt company, let's say Kingfisher Airlines. If you are buying the share of Kingfisher Airlines, then Kingfisher Airlines will say, no, we are very safe. It's up to you to decide whether you should buy that share or not. And for that, you do the risk pricing. So risk pricing is a different concept than risk management. This is done by the buyer and this is done by the seller. Okay, so the answer is B, 1 to 4 only. Got it? It is 1 to 4 only. Next one. The market risk management policy formulated by the board of directors of a bank generally takes into account, number 1, market risk management policies, market risk management procedures, aggregate risk limits, risk review mechanism, reporting and auditing systems. So what does it take into account? Yes. Market risk management policies, procedures, aggregate risk limits, review mechanism, and auditing systems. What do you think? Yeah. Here the answer is A, 1 to 5 all. Okay, all of them. Because whenever board of directors formulate a policy, whenever they have to take into account the lowest level person, how will that person work? How will that lowest level person react to the policies? Okay, how will that person try to uh, avoid his work using this policy? All these things it has to take into account. So it will take into account all the 5 elements. Okay, risk management policies, procedures, aggregate risk limits, review mechanism, and auditing systems. Which one of the following is not the part of the role of asset liability committee, ALCO? Which one of the following is not the part? So ALCO, here in market risk management, always remember ALCO focuses on generally market risk. ALCO, there are 3 committees. One is ALCO, second is CRMC, third is ORMC. ALCO looks at market management, market risk, CRMC, credit risk, ORMC, operations risk. So which of the following is not the part of ALCO? Product pricing of deposits and loans, setting guidelines for the market risk management and reporting, funding policy and transfer pricing, and balance sheet management. Which is not the answer, not. Yes. Product pricing of deposit and advances, that is a part of ALCO, because product pricing means what? Asset liability management. That is the main job of ALCO. So A is this. A, I'll write this true over here. Whatever is true, I'll write true. We want a false one, not. Okay. Second one, I'll focus on C. Funding policy and transfer pricing. So this is also true. Transfer pricing means this is a separate topic altogether. Transfer pricing means the rate at which you sell your bonds or sell your assets to your internal company, internal department. Means if retail banking is having the loans of housing loans of let's say 1000 crore, so those housing loans are sold to the treasury of the same bank, and the pricing decided for that is known as transfer pricing. Okay, there's a big topic on this. Someday I'll explain you in details, giving various examples. Okay, I'll give you one more example in this. Suppose if your branch is transferring the computers, let's say, now let's take 1 minute. Your branch X, okay, your branch is having computers. Branch X, okay, is transferring the computers to branch Y. So both are the same bank branches. So you should give it for free. But do you give it for free? No. What do? You charge them some basic price, so that your branch profitability. Now look at this. I'm talking of branch profitability, not bank profitability. Because when you transfer the computers, your asset is gone, and this asset is received by this bank, this branch. So your asset profitability, your asset is gone, so your branch profitability will be affected. So you charge the basic price, minimum price we call it, and this minimum price is called as transfer price. So that is the job of ALCO, not computers. Here I am giving you the example of computers. The example is of loans, of bonds, all these. Okay. Balance sheet management, that is the job of ALCO. This is not the job of ALCO. Setting guidelines for the market risk and reporting. Reporting is a compliance part. Okay. Setting guidelines for market risk management. Guidelines are not set by this ALCO team. Guidelines are set by the board of directors and RMCB. Got it? Clear? So that was a session for you. Now before going, I would suggest everyone to join the AIM batch for CAIIB and the Mahapack. In AIM batch, all the numericals, objective questions, case studies are covered. In Mahapack, you get double validity, plus you get multiple batches per subject. Now let me show you. Let's go to Adda 24/7. I'll always suggest you to go through the app. In the app you get 1% extra using the coin systems. Okay. So go to Adda 24/7. Let me take you. So this Adda 24/7. Go there. Click on CAIIB CAIIB. Click on CAIIB June 24. Okay. Now click on the AIM batch. Look at this. All the details. Ebooks, test series, online live classes, counseling, recorded videos, doubt solving, and experienced faculties. And look at the discounts. Click on buy now. Put the code Y432. Never forget this code. Y432 because that is the maximum discount code. You'll get 80% off over here. 80%. Say this. 80% off. Plus if you buy through the app, you'll be getting 1% extra. Okay. Similarly, Mahapack also. Join the Mahapack. I'll always suggest you see this. Mahapack is one of the best options. Go for the Mahapack. Click on CAIIB Mahapack 2.0. Now you see this double validity. You buy for only 6 months. You get it 12 months. And look at the fees. Same thing. Discounts. Everything. Okay. Buy now. Put the code. Never forget this code here. Y432. Click on apply. 80% off. Okay. Plus double validity. Both the offers are available. So immediately join the batches and the Mahapack.